In this segment, we're going to talk about the value of bonds. How much are they worth? After listening to the prior segment, I can tell you that I'm so sorry for you that this is so boring and I'm so dull doing this online. And I wish I could do this live, but we're going to do the best we can here. The value of a bond actually has multiple values. There's the value that's shown on the balance sheet as a liability of the company that issued the bond. So it issued bonds at par value. That's the liability, the future liability that it has. Those bonds, however, could get sold. They would have a value being sold. That value might be greater or less than whatever shown on the books, right? Something is worth whatever someone's willing to pay. And that's basically what the market value is. In the secondary market, people buy and sell bonds. People want to get rid of them. People want to own them. And they're worth whatever someone's willing to pay. Then we can calculate actually an intrinsic or value to them using some of the theories and stuff that we've begun to explore. And what we would do is look at the present value of the expected cash flows from that bond. Talk about that in a second. Okay. The value of a bond, the future value of a bond, is affected by how often you get paid, how risky those payments are, and our required rate of return. The required rate of return is an important concept. That's different than the interest rate, the coupon value of the bond. The required rate of return is what the investor is looking to achieve in order to give up the opportunity costs that he or she has. We can calculate this. This is kind of a horrible looking formula, but it's the present value of future cash flows. So we take the cash flow from period 1, take the present value of that, add it to the present value of the period 2, add it to the present value of period 3, and so on, all the way out to the end where we calculate the present value of the par value of the bond. Now, you don't need to know this formula. I'll show in the next exercises how to calculate these using Excel. But it's good to know theoretically what we're talking about. We're talking about the present value of future cash flows. And this is going to come up over and over again when we're looking at the value of something. We're always talking about the present value. Now, bond yields. There's two ways in which the term yield is used. One is yield to maturity. That's the present value, the expected rate of return. So we're going to, in Excel, use a rate calculation. It's the expected rate of return of the cash flows. So we pay for something, that's money going out. We get an annuity every 6 months, we get that interest payment. And in the end, we get the future value, which is the par value. We get that discounted today. So we can use a rate function in Excel to calculate what the return is of all of those. Most commonly, you hear people use the term yield, and they mean current yield. That's a very simple calculation. You take the interest payment from the bond and divide it by the price. So for example, let's suppose a bond pays $40 2 times a year. That's $80 a year. $80 divided by a par value of 1,000 means the bond is paying 8%. That's the yield. If the bond price goes up or down, that yield will change. And we use the yield to compare to alternative investments. In other words, if we're going to compare it relative to the return we could get on a preferred stock or a money market fund or something like that, we will use the yield to compare those values. Bonds have risk. First risk is default risk. We've talked about that before when we were talking about interest rates. The greater the default risk, the greater the rate of return is that you require. Interest rates risk. Interest rate risk is if interest rates go up, then I want my required rate of return to go up, right? But if interest rates go up, they can rise above the coupon value of the bond, which means I can get better interest rates someplace else. So I will have to, or I'm willing to pay less for that bond. Let me try that again. If interest rates go up above the coupon rate, I'm not willing to pay as much for that bond. I require more interest than the bond is paying. The only way you can get me to buy that bond is to sell it for less. So when interest rates go up, the bond price goes down. If required rates go down, now that bond looks attractive and I'm willing to pay more. So if required rates of return go down, bond prices go up. If required rates of return go up, bond prices go down. They go in the opposite directions. It's probably easier understood looking at inflation. When inflation goes up, those interest payments and that par value that are out there years ahead of us are worth less. Right? Because of inflation, the value is less today. So if inflation goes up, I'm not willing to pay as much for the bond, and the bond price goes down. If interest rates go down, now that bond price looks pretty attractive, right? The value out there is bigger. So if inflation goes down, bond prices go up. That works the same way as interest rates. They work in opposite directions. There's also the maturity risk. We saw that with regular interest rates when we calculated the premium. The longer maturity, the higher the risk of a bond. It's important to kind of understand this slide. It says what I just said before, but in a little more technical terms. But you will hear people talk about bonds in this way. The price of a bond will be below par if a required rate of return is above the coupon rate. That's what we just talked about, right? If my required rate of return is higher than the interest rate on the bond, my price will fall below par. We'll see that in Excel. I'll actually work a problem. And it works the opposite way too. Right? If my required rate of return is less than the bond, so let's say I require 4%, but the bond is paying 8%. Whoa, now I'll pay more for that bond. Right? The price of the bond goes up. If you're comfortable with arithmetic, just go look at the calculation of the yield formula. The yield is equal to the interest payments over the price. So if the yield goes up, it has to do it because the price goes down, and vice versa in that simple equation. Finally, we look at the yield curve. The yield curve is simply a graph that shows the yield on the y-axis compared to the maturity on the x-axis. The normal yield curves look like you see here. They're upward sloping. And you'd expect that given maturity risks and the inflation risk. The longer the maturity, the higher the yield that the investor requires. But that's not always the case. Here in 2020, the yield curve is inverted, meaning it slopes the other way. People want 10-year bonds and are willing to pay higher prices. And if the price is up, that means the yield goes down. So 10-year bonds have very low yields, and it has been inverted. This is part of the flight to maturity in times of crisis. People want to buy U.S. Treasury bonds. They buy long term. When they buy them, the price goes up, making the yield go down. But the normal yield curve looks like this. Now, online you can find a number of different looking yield curves. If you just Google images for yield curves, you'll see ones through various periods. And they change. As the Federal Reserve changes interest rates, it affects the yield curve. Or as events and markets anticipate what's going on, the yield curve will change. In the next two segments, we'll look at how we use Excel to calculate these values. And it might be easier to see it by looking at actual calculations and see what happens.